Hi guys, my name is Benji Law from Bridge to Freedom, and welcome to another video of how to grow your real estate empire. Now, as I mentioned last time, in this video, we're going to cover the topic of how to differentiate between an asset and a liability when it comes to purchasing a place. In my opinion, this is definitely the most important topic because it can mean the difference between having to work hard for the next 20 years, paying off a mortgage, or being able to buy a place, let it take care of itself, and then moving on to the next one. So super important topic. Let's get into it and I'll show you how to differentiate between an asset and a liability. There's a few areas that we'll need to cover. Some of them are a bit more in-depth than others. So what I'll do for this video, I'll just touch on those briefly and then I'll make a completely separate video for those areas just to give everyone a better understanding. So first thing we need to go through is the two different types of people buying places. That's very important. Secondly, we'll go through the difference between equity and cash flow. By far the most fundamental aspect of purchasing property that you need to understand. I'll also talk about the difference between principal and interest repayments as opposed to interest only repayments. And I'll take you through some real life examples of how to analyze whether a property is an asset or a liability from day one. And finally, we'll look at the difference between long-term rent and Airbnb or any other type of short-term rental. Talk about this first area, and that's the two different types of people that are purchasing property. The first type of person is an emotionally driven purchase. Now that involves something like, you've all heard it before, this house is beautiful, it's got a big backyard, or I need the extra space because we have a growing family, or this is my dream home, I've been saving up my whole life and I can finally afford it. Nothing wrong with that. That's why we all invest in the first place. But it's very important to realize that when you purchase something like that, you're purchasing based on your emotion and not on financial statistics. The second type of person is someone that's buying a place because they want a financial reward. They either have the view of a short-term or a long-term profit, and that's why they're buying the property. You might be one of those people buying a house based on emotion. We can still help out with those type of purchases. So if you want us to negotiate the price for you, or analyze the numbers before you buy it, give us a call and we can still help. Now for that second group of purchasers, people that want to buy a place because they want a financial reward, that's what all these videos and that's what our company Bridge to Freedom is all about. So we've identified the difference between buying something based on emotion and buying something for a financial reward. The next thing is to understand the difference between equity and cash flow. Now, for all those that don't have a degree in accounting, I'm going to highlight the differences between equity and cash flow very simply. Equity is a hypothetical number that sits on your asset. For example, you've got a property that's worth 500,000, hypothetical. Your loan or mortgage on that property is 350,000. That's a real number. So your equity is 150,000. It's that easy. Whereas cash flow is how much money is coming in or going out of your pocket every month. Now, equity is great for long-term wealth. For anyone that's doing short-term buying and selling and flipping properties, that's a whole separate topic we'll talk about later. Whereas cash flow is going to be in the difference between you having to get up and go to work for the next 20 years or being able to sit on the beach and watch your properties take care of themselves automatically. For you to be able to grow your property portfolio, cash flow is very important. If the first house you buy is going to be costing you money every month, it's going to be very hard to save up. You're going to lose your confidence, and then buying that next one's going to be so much harder. Equity is important, don't get me wrong, because when you build equity in a property, then you can use that to purchase your next one. But from a freedom point of view, remember the company's called Bridge to Freedom, that's what we're all about. Cash flow and being able to have a property that you don't have to take care of is far more important. The other reason I don't like to rely on equity just by itself without taking into account cash flow is because it's a hypothetical number. Equity is based on what someone's willing to pay for your property or what the banks value it at. Now, the problem with that is that if you only rely on equity and you buy a place that's costing you a lot of money with the hope that one day it will be worth more, if anything happens in the future that you haven't predicted, like a pandemic or a recession, and you end up selling the property at a loss, not only have you worked so hard to actually pay that mortgage off, but you've also lost money in the value. Whereas at least if you take into account cash flow and something goes wrong and the property's been still generating you a profit the whole time, you haven't had to work for that. and you've given yourself the freedom. Now, staying in line with the whole topic of this video, which is differentiating between an asset and a liability when it comes to property purchases, we know equity is a hypothetical value. And we also know that cash flow is money coming in or going out of your pocket every month. Based on this knowledge, a property that's an asset has to be a property that is generating you a profit every month, i.e. you receive your rent and after all your expenses, including your mortgage repayments, you're left with money in your pocket. It's as simple as that. The same also works in reverse for a property that's a liability, which is taking money out of your pocket every month. A lot of people are thinking, Benji, based on that definition, why does my accountant list my car as an asset or my tools for my company as an asset? Because they're losing value. For the purpose of identifying a profitable property as an asset, we're not interested in the accounting definition. If you want a better description of how to list a property as an asset, go and read the book Rich Dad, Poor Dad, because it describes it far more elegantly than I could in this video, in a lot more depth. Now, we've identified what an asset is when buying a property. I'm going to dedicate the whole next video to examples and practicing going through those numbers, the income and expenditure, to make sure that before you buy a house, that it actually is going to be an asset. But I'll run through a quick example now. Let's say, for example, you buy a house for $500,000, you're getting $500 a week rent. After your mortgage repayments and all the other associated expenditure, you're left with $20 a month profit. That is an asset. Even if it's a small profit, it's still an asset. I won't get too involved in the specific numbers of analyzing if a property is an asset or not in this video. That will be in the next video. But one thing I can't move on from yet without touching on just slightly is the fact that when I run these numbers, it's based on interest-only repayments, not principal and interest. I'll talk about that in a separate video again because it's super important. But know that interest-only repayments is what most investors will use, because then that difference in repayment amount, instead of having to pay the principal, they can save that and use it for another purchase. If you do want to pay principal as well, that's fine, but treat that as savings. You're paying off the principal of your mortgage. When it comes to identifying a property as an asset or a liability, we've made spreadsheets on our website available for download, which you can put data into each field, and at the end it will show you whether that property you're intending on purchasing is going to be an asset or a liability. Every financial investor is going to have spreadsheets similar to these ones. Really, if you want to grow an empire, it's very hard to do so without these type of templates at your disposal. Another thing that I wanted to go through as well is short-term rental markets such as Airbnb or holiday letting compared to long-term rent. When it comes to analyzing the property as an asset, once again, we use long-term rent. This current situation with coronavirus and Airbnb really shutting up shop has showed everyone, especially real estate investors, that they need to be able to rely on long-term rent. So when you're putting those figures into your spreadsheets or doing the numbers yourself, that property has to be profitable based on long-term rental figures. Next video, we're going to go in depth at looking at properties as assets, going through the income, the expenditure such as mortgage repayments, rates, insurances, real estate commissions, maintenance, all those in-depth things. Also, go to our website if you want to do it yourself, download those templates and have a look at those items and come to the conclusion of an asset or a liability by yourself, by all means. The property market at the moment is becoming more and more interesting, and I think the opportunity to get a good price is just going to increase in the next 6 to 12 months. So if you want us to negotiate property prices for you, or have a look at the properties and generate a report for you before you buy them, get in touch with us. We're more than happy to help.